Hello, and welcome back to my YouTube channel. James here, as ever, for today's ACCA Management Accounting F2 exam video, where I'm going to walk and talk you through the 3 Section B questions that you can find on the main CBE on ACCA's website. Just going through the questions, we've got ratio analysis, variance on here, so make sure you stay to the end. This is a quick and snappy video so you can go through the answers. I've done more detailed videos on these on my channel, but if you are new to watching any of my videos, hello, my name is James. I'm an ACCA qualifying member from the UK, and on my channel I help our ACCA students pass their examinations, and I also dedicate my videos to my lovely subscribers. So as you can see in the middle on the screen now, we've got Early Karma. Thank you so much for the request, Early Karma. You've obviously watched my business technology one of these videos, or the previous F2 video that I also did on the extra MTQ questions for Section B. So I'm just going to walk and talk it through now so that you can actually break it down and go through some answers, have a go at it yourself. If you would like to have a go at this question before you watch the video all the way through for the 3 10-mark questions, the link is in the bottom, and what you need to go to is click that specimen exam and MTQ, then go on to here and click for the full exam, and then go straight the way ahead to question number 36 on there. And as I said, if you are new to the channel, and just like Early Karma, if you'd like access to all my free resources and videos, all you need to do is hit subscribe below. And of course, as ever, thank you so much for all the support for the channel. I really appreciate it, as ever, if you gave the video a massive like and thumbs up, so that more ACCA students can see these videos, benefit from them, and it can just be that little difference in getting those final few marks to pass your next exam. If you've got any questions as we go through, any other requests, leave me a comment below. Also, let me know how you get on in your exam. Would love to hear how you get on. But we're going to first of all look through Cabco on here, how they own and run 350 taxis and had sales of £10 million. The first question on here for question 36 is all about the net present value. So for this one on here, for your answers, you should have had a go at it yourself, but I'll walk and talk you through the reasons behind it, the right answers. So make sure you watch to the end, get a pen and paper at the ready. This is definitely going to help you out. So for this question on here, it was all about, is the actual figure relevant to the MPV evaluation, yes or no? And what that means is, should we take into account the figure when we're doing our MPV calculation? Now, an MPV stands for the net present value, where we total up all of our positive and negative cash flows, giving us a total cash flow for that particular year. We might have a 5-year project, so you're going to have total cash flows for all 5 years, and we're going to total them up, whether they're positive or negative, discount them at a cost of capital that we're given within a question. In this case, it was 10%. And then that is where we're going to get, at the end of the day, a positive or negative MPV. If it's positive, we go ahead with the project. If it's negative, we actually reject and don't go ahead with it. So this computerized system on here that we're given in this question for 36. So the first one on here, the tracking system for the investment of 2.1 million, that is relevant because you'll see up at the top that we need that 2.1 million system implemented to actually get the project going overall, to actually get it so that for all these other staff costs and other things on here that we have, maintenance, borrowed costs, they wouldn't be actually incurred if we didn't have the actual tracking system investment put into place. For that tracking system, we also had some depreciation for the project over 5 years, and that is irrelevant. That is because depreciation is not a cash flow amount, it is a nominal value that is calculated through policies such as the straight line or reducing balance. It is not a cash flow actual item, so hence is irrelevant for an MPV calculation. Be careful on the staff training costs, as we had some that were a sunk cost before the project started and some that needed to be incurred after the project started. And the $425,000 is up here, so the further training costs of $425,000 would be required in the first year if the system was to be implemented. So that should be relevant for you on there, that if we didn't incur that, the system is not going to work effectively. New staff total salary of $120,000 per annum was in note 6 on here, so we had 6 members of staff recruited to actually manage the new system, to get it up and running, and so it processed correctly. So without them, is it going to work? Well, no. So they are definitely relevant to it on here. Then we've also got for the staff training costs of £75,000 or $75,000. And that linked into, again, point 3 on here, that $75,000 had already been spent on staff training in order to evaluate the potential of the new system. Now, this was a cost in the past. It's already been incurred. That is what is known as a sunk cost for your notes on there, and should not be taken into account and is irrelevant for the MPV calculation. Finally, coming on to the interest cost of $150,000 on here per annum, which was in note 8. This is all to do with the actual money borrowed to finance the actual project. And what you'd probably think to that is, well, if we borrowed the money, James, we've got to pay some interest, that surely should be relevant. This is where your actual financial management knowledge as to understanding the percentages, the key terms, and the key term to get down here is the cost of capital of 10%. Now, when a business is formed with debt and equity, we actually get a cost of capital based on that. And a cost of capital is the rate that the business can borrow finance at based on their capital structure, how the business is set up. So embedded within that 10% is the debt and the cost of that interest, that if we're actually got poor financing, that's going to put the cost of capital up, and hence we would have more to pay. So in other words on there, that is where the physical $150,000 is actually irrelevant, because the actual interest is factored in to the cost of capital within that 10% on there for your notes. Well, that nicely takes us through task 1 on there. And we're now asked to go on to task 2, where we're going to have to get the calculator out. I'm just trying to keep it as nice and easy and flowing as possible. Incremental sales. Key thing here is, what it's looking at is, we've got a new system. So it's saying here as to what would the sales have been actually with no system, tracking system to be more specific, and what would the sales be actually with the new tracking system, so without or with. And the incremental sales is the difference between on there. So we need to go back up to the actual question that, again, just to read it carefully, is all about year 1. So heading up for year 1, we were told in the question that sales are expected to rise to 11 million in year 1 if the new system is to be implemented on there. Cool stuff, rock and roll for that. But now we've got to work out what would the sales have been if we didn't have this new system. And that's where we had up at the top that the sales of $10 million in the last year for Cabco. So that's what they had in year 0, but we're interested in year 1. And we were told in one of the notes that sales would be expected to increase in note 4 by $200,000 per annum. So in essence, what it's saying there is we had $10 million plus 200,000 on there. So the incremental sales is going to be that 11 million on there minus our 10.2. Let's make sure we get the right number of zeros. So that is going to give us incremental sales of $800,000 on there. And it asks to give us the figure as a whole figure on there. No 2, James. There we go. So 800,000, that is what we need to have a look at on there. And to get it in the right format. If it had thousands on the side there, we'd only have to put in 800 because the system's already taken into account the thousands. But in this one, it didn't. But you can see here, but they sometimes put to the nearest thousand. We'll come on to that in a moment. We then had on here savings in vehicle running costs in year 1. So head back up. We've got the actual running costs on here. So savings in vehicle running costs, if you look at note 5 now, are expected to, as a result of the new system, these are estimated to be 1% of actual total, 1% of total sales on there for year 1. So you've got to say to yourself, what did we have in year 1? We had $11 million, with me multitasking now and trying to do it as clear and concisely as possible for you, not to bore you with any management accounting. But here we go, 11 million on there, multiplied by our 1%. So that is where you look in note 5. These savings or running costs are actually meant to be 1% of total sales. that tells us that the savings of those running costs are for this year in year one going to be 110,000. So there you go, 110,000 for year one on there. Now the final one is the present value of the maintenance costs over the life of the contract. So if we head back up here to, just to be crystal clear, it's the maintenance cost on there. So we were told that in note 7, Cabco had to take out maintenance contract for the new system at a cost of £75,000, dollars, James, annual for 5 years. And what that means is that we're going to have $75,000 every year for 5 years. But what we don't know is the present value of those 5 £75,000 payments. Now, for your notes to that, we now need to use one of the key tools that you're given within the examination, and that is an annuity table that you can see on the screen now. There are 2 tables that you're given in your exam. The present value table, which discounts, so this is not the one we're going to be using, because as you can see on the screen, the numbers get smaller and smaller and smaller and begin with 0 point. If you multiply any of these numbers and it discounts figures back to the present value, it's going to make them smaller because we've got a 0.942, for example, on there. We're looking at an actual future value now that we need to discount in the form of an annuity, and we now need to consider the factors that were asked in the question. So it's going to be paid for 5 years into the future on there. And also we were told the cost of capital, if you have a look at the last note, was 10%. So the key figure that you need to get down, you can see where my mouse is 3.791. So 5 years at 10%, 3.791. And if I get my calculator out for you, we do 3.791 on there, multiplied by the 75,000. And this is going to tell us the present value of those 5 £75,000 payments on there. We were also told to actually put it to the nearest 1,000 on there. So it's just going to be down as 2, without me taking it off, 284,325. 284,325 on there. The reason why they say to the nearest 1,000 is that a student could actually do this manually, they could go to more decimal places, and hence that is where there might need to be some rounding up or down. But the ACCA does allow for a bit of wiggle room on there, that if you do have a bit of rounding, it will still give you the marks for it. Coming on to task 3 now, at the bottom, where we're told a few different statements about the IRR, return on capital employed, and the payback period of being for 4 years. And we're being asked which of the following is true. Now, always look at these and say, well, hang on, I've got to read these through carefully. And when it says which of the following is true, they only want you to select one. So we've got on here that the project is not worthwhile because the IRR is less than the actual return on capital employed. And the key thing to be aware of from here about is it true or not was maximise the wealth of shareholders. And this is where we now need to be judging these because we're asked correctly calculated the following measures on the proposed actual system. So the project is not worthwhile because the IRR is less than the return on capital employed. Well, that is not true because the IRR and the return on capital employed are different measurements within the actual financial statements on here and the company that runs it. So return on capital employed is all about the debt and equity that you have within the business and how much operating profit have we made. So from an investor's point of view, we want that to be as high as possible. Now that really doesn't link into the IRR because that is project specific on there and they're not really comparable one to another. So it's definitely not that. The project is not worthwhile because the payback is less than 5 years. Well, again, that doesn't give us enough details on there. The project is not worthwhile because the payback is less than 5 years. Well, yes, the payback period is 4 years on there, but in terms of maximising shareholder wealth, we're not entirely sure as to how much is it actually receiving on there. It doesn't go into enough detail for the levels of return. The project is worthwhile because the IRR is greater than the cost of capital. Now, this is the correct answer for you on there. And if you haven't already, have a look back at your core text to see how an IRR line interpolates, because the key fact for you to get written down is when the IRR, so at 14%, that gives you an NPV of a project to be naught. So it's not generating any economic wealth and it's not reducing any. However, if the cost of capital, which we had in this case, was lower than the IRR, or they worded it here that the IRR is greater than the cost of capital, well, we had a cost of capital of 10%, that tells us that at the current cost of capital rate of 10%, the project will generate, based on the IRR, a positive NPV. Key thing to note down is the interpolation of the diagram. Check it off that when you go to the 10%, you'd come up on the diagram and it will give you a positive NPV. And the final point, the project is worthwhile because the IRR is a positive value. Well, 99.9999% of the time, you're always going to have a positive IRR for this, because if it was the flip side, then it's not a cost of capital rate that we're borrowing from. Then the lender would be paying us money if it was at a negative percentage. That can't possibly be right on there. But that takes you through nice and quickly. Question 36 on there. So we need to reset this on here, and let's just pull up the calculator for you. So we just need to cancel that on there for you. Now we've got the toy robot question now, which again, if you haven't already, pause the video, go through it, whatever works best for you. And we're asked about this formula on here. So it's a classic sort of question. Excel, you've got the rows and columns, 1 to 19, A, B, and C. And we were asked all about the formula which will calculate the direct labour efficiency variance for B18. So straight away you go down to B18, which is 48,000 favourable on there. And then we go into it and say, right, let's just work them through as to how we're actually going to calculate this. So C9 multiplied by C4. So C9, as you can see on here for the production, and then we've got C4 of 48. So let me just put it on the screen for you. So you got C9, 26,000. Nice and easy on there. Multiplied by C4, so 48. And I'm just going through the first one on here. So that gives you 1.248 million minus, and the 150,000 comes from the direct labour. So when I see direct labour efficiency variance, we've got to be taking into account the actual number of hours and then putting that into dollars, what we're asked on here from a monetary perspective. So remember, 1.248 million on here. And now we've got to, and sadly I can't do this on this calculator because we run such a high budget channel, should we say, but let's do 150,000 multiplied by 8. I'll remember it on here. So 150,000 multiplied by 8 equals 1.2 million. So the alarm bell should be ringing to you there to say, well, 1.248, 1.2.3 minus our 1.2 million that we've just calculated will then give us a 48,000 favourable on there answer, which we are currently looking at. So if you want to watch the video where I go into a lot more depth from there, just as a little overview as to why the other answers are not correct on here, for the bottom one, it's calculating it exactly the same. So that 150,000, but the key thing here is, you know how I had to put it in the calculator the other way around? What this one, what the bottom one there from the 150,000 is doing for you there is that instead of it saying that way around, it's doing, you get the exact same figures on there, but it would be 1.2 million minus 1.248, 123. So you get 48,000, but an adverse answer. It's not actually put into the formula correctly on there. So it can't be the bottom one, and it can't relate to B13 on here, because that is what the actual physical actual amount was for the year, how the business actually operated. Whereas what we're looking for from a direct labour efficiency variance is all how the standard cost was lined up versus the actual number of hours that were put into it, that 150,000 on there. That 1.221 million factors into another aspect on there, which was a bonus, which we'll come on to later on in this question. But like I said, if you haven't watched the more detailed video on this, feel free to check it out, because it is a real tricky one to get your head around on here. But coming on to task 2, the best way to go about this in any question is look at the things that we've actually not got any figures, we're missing out on here. Notice what we've got in terms of what the examiner's given us. So we're being told that the budgeted contribution was $700,000. The actual contribution was $735,880 on there. But it's these bits up here that we have as blank. And as ever, this is the key thing to get down in your notes. What most students would do is they would just go for the first little drop down bar on there. Don't do it. Don't fall into the trap. If you watch the other video, I sort of half fall into it. I'm trying to work out where all the figures are coming from. The first thing you want to do is the sales price variance on here. And we've got to be putting in the actual figures. And again, deciding if it's adverse or favourable. So remember, any variance question, focus in on the key words to direct your answer. Sales price variance. So let's head back up to the actual question up here. So we're looking at the actual sales for the year was so we've got $3,066,880. That was physically what actually happened. But now what we've got to say is, well, okay, what were we expecting to happen throughout the year? Are we in a better or worse off position on there? So what we need to do is take the actual sales, so the 25,600. So I'm going to go back into multitask mode on here. 25,600 on there. So this is what actually happened. Multiply it by the 120 for the sales price. So that is the figure on there. So $3,072,000 is what, based on the standard cost, we should have generated in sales. However, what you should be saying to me now is, James, we've actually had less. So we are in an adverse position. So if we minus 3,066,880, we are worse off $5,120 on there. And that is adverse. That is the first one to get down. Keep it easy on there as you go through. That is where it's going to help you out to give you the easiest way of working this out on here. And then the next thing, again, if you watch the other video, I was trying to word this a lot more clearly, but the best bit of advice is just stick to what they've given you first of all, and then the other figures will flow in that you can work back. So what we're given on here is the standard contribution on actual sales. So just do it as it says it on there. So standard contribution on actual sales. So we know the actual sales. Again, come back to it. Actual sales, 25,600 multiplied by the actual standard contribution. So that is where we got the 28. I think I've put in the multiply. There you go, 28. So our figure on there is 716,800. 716,800 on there is our correct answer. So then we've got on here that we've actually got a balancing figure in between, so that it should have been down to on here. We've got a budgeted contribution of 700,000. We've then got a standard contribution on sales of 716,800. Now to get to that, we've then got a difference, and that is where we're going to have a sales volume variance difference as a result on this. And then we've got to say, well, what is the difference? Well, we know what it is. We've got a balancing figure on there that's, for anyone who, in fact, let me just put it on the screen just in case anyone's wondering where I'm getting this from. 716,800 minus the 700,000 for the budgeted contribution. So the sales volume variance on there is, as you could see, 16,800 as a result. So what were we expecting was 700. We actually got more than we were expecting, the 16,800. So the final thing to do is put that it is favourable on there. But notice how by just simply walking and talking through the words that they gave us in the question, we picked up on a minimum of half marks on that and then worked it out logically based on the balancing figures. Coming down to task 3 on here, that you were then asked about which of the two following could explain their interrelationship. Now, interrelationship is all about, are they linked and are they true based on the information that we're actually given. And the first one on here we've been given is the actual production was less than budgeted. So straight away there, was the actual production 26,000 less than budgeted? Well, that is false because the budgeted was 25,000, the actual was 26, so that is incorrect on there. A productivity bonus was paid to direct labour. Now, I hinted at that already, but let me show you where that comes into effect on here. So if we come back up to the actual direct labour on there, so the 150,000. So what that, remember from the actual standard costing, that direct labour we pay at $8 per hour. So the 150,000 multiplied by 8 gives us 1.2 million. That is what we would expect to actually be paying for the direct labour. However, what we did pay was, let me put it in the calculator, 1221, and then 3 more zeros on there. That is 21,000 in additional cost, which gives us that a productivity bonus was paid to direct labour. Well, were they productive on here? The direct labour efficiency variance was favourable. So they were productive on there and they got paid a bit more. So that is my first one, I'm pretty sure is correct. And then the final two we've got on here, the higher grade labour performed tasks more efficiently. And then they've got low grade labour performed tasks less efficiently on there. Well, you can see by me highlighting it on there that we've got they actually perform tasks more efficiently on there. And there's your 2 out of 2. But it's, can you just see how just trying to walk and talk it through logically, it may be a bit of a scary question, I know, but there are easy marks out there. Just stay focused in on the key terms, break it up, use the bold titles on there. That is going to be a key exam technique to help you get 10 out of 10. Now, moving swiftly on to Nicholson Co. That is the next one on here. And as you can see, we're going to have some ratios. So let me clear this off for you on here. If you haven't attempted this as well, feel free to pause the video, have a little go through, because this is actually, because it's a quick video, I'll mention it, this is the second CBE question in this line that I've seen about these ratios, so they are super important that you know them. They can be such easy marks to pick up on in your exam. So pen and paper if you want the formulas to get down. The return on capital employed is your profit before interest and tax. So the 48 million on there, that's for 48 million that you can see on there. Let me just make sure we get it all on the screen so that make it easier for you to follow. So the 48 million divided by, lo and behold, your actual capital employed. So divide that by the 192, 192 million, 1, 2, 3, 1, 2, 3. Now, key thing with percentages on your management accounting exam. Notice on there, there'll be so many students that would give 0.25 as their answer. What you need to give it is as a whole number, like you would do in a workplace. If I was to put in 0.25, as you can see on there, incorrect answer. If I was to put in though 25%, 1.5 marks on there. Do not throw them away. Trust me on that. Next one, we've got return on sales. So coming on to it now. So the return on sales, also known as the operating profit margin. Again, easy, simple marks that we've got the profit before interest and tax at 48 million, 1, 2, 3, divided by the sales revenue. So 480, 1, 2, 3, 1, 2, 3, equals 0.1 times by 100. There you go, 10%. Another easy mark in the bank. We've got the asset turnover now, so let me just pull up the calculator again. And this is all about the actual revenue on here to 480. And then this is all based on the capital employed. Now, capital employed is all about what money has been invested to the business, whether it be in the form of debt or equity. And we're wanting the sales to be as high as possible. And it's basically saying from the investment into the business, we want to generate as much revenue as possible. So take that capital employed of 192, 2323, cool, 2.5 times, and we want it to be as high as possible on there. A little giveaway for the final one down at the bottom here, where we're told it in terms of number of days, and for your note on there, if you ever see that, so it could be trade receivable days, inventory days, trade payable days, we're actually told about the average wait time for a telephone repair to the nearest whole number. We will be multiplying our answer by 365 on there. So coming on to it, we've been told that we're looking for telephone repairs. So have a look through that we've got average number of telephones unrepaired on there, and the average number of telephones returned for repair each year. Nothing else really to do with repairs, and this is not a ratio that you're going to see in any book. It's looking at that you can understand comparisons between two variables that we can actually draw some conclusions from. So what you need to do is take the 804 for the average number of telephones unrepaired at the end of each day, divide that by the actual 10,000 now, which is the average number of telephones returned for repair each year, and that gives you 0.0804. But because we need this in terms of number of days, not as a decimal, this is where we're going to multiply that by 365, as we said, and that is going to tell us that the average wait for a telephone repair for a customer is 29.346 days. We are asked, however, to the nearest whole number. Now, for me personally, I would always be putting down an answer for this of 30, because without that 0.346 of a day, then we're not taking into account the full data of the 804 and the 10,000. However, because it's 0.3 on there, ACCA does allow that most students would see 0.3, and so hence they would round it down. So just to show you on the screen that if you did write 29, it would still be marked correctly. So if I took off 29, re-put it in, 6 out of 6 for you on there. So just taking you down to, again, some more statistics that you go, oh my word, James, you know, we've never done anything on this. Easy 2 marks, not to throw away. Just focus in on the key terms that you were asked in the question, to follow the statistics and to give your answer to 2 decimal places. So it's all about the percentage of customers lost per annum is the first one on here, and the percentage of sales attributable to new products. So let's focus in on customers lost per annum. So say to yourself, right, how many customers have we lost? So we've got 117,600. And then how many customers do we have per year? So we've got 1.96 million. So we'll just do the maths on there. We can work out the actual comparison. So 117,600, okay, divided by 1.96, just be careful on your zeros as well, equals 0.06. Notice again, we're asked to 2 decimal places, but we need it as a whole percentage on here. So multiply by 100, nice and easy for the first one, 6% on there. The second one, sales attributed to new products now. So let's head back up to sales and notice how the top ones are all in dollars. So these are monetary values. And that's where we're asked about sales for new products of $8 million. And that $8 million is actually part of the overall sales revenue. That's where we want to work out the percentage that it actually fits in. So 8 million on here, I'm just going to do the whole figures, not to take off any zeros to confuse anyone, divided by the full 480 on there, multiplied by 100, and this is where we get an answer now of 1.66 recurring. Now if it was me in a management accounting exam and I'm told to give answers to 2 decimal places, you have to then refer to the third decimal on here. Because it's 6, it's above 5, so we have to round the second decimal, this 6, oh, that 6, up. So my answer would be 1.67. Now for your benefit on here, the ACCA marker is actually a bit lenient on this. I had a look of the actual examiner's report, and they will allow for this 1.66 as well. But notice how, just stay focused on the wording, work it out correctly with the right amount of zeros. But if it was me in the exam, I'd stick to what they're asking for, 2 decimal places on there. Coming on to the final bit now on task 3, all about balanced scorecards. So if you haven't already had a look at the core text, they've got a nice little diagram on there. It should be broken up into the 4 sectors, internal and external processes. And we're actually given some of these perspectives of customers, innovation, learning, financial, and other options. So it's designed to show up a student that is well prepared, they've had a look through the core text, versus someone who's going to have a 1 in 3 guess. Now, even if you're a student who's having a 1 in 3 guess, let's have a look to say what looks reasonable here. And think to yourself, customers, innovation, learning, financial, and non-financial success. Does that sound right to you? No, not really. Customer, innovation, learning, financial, and process flexibility. It doesn't quite fit like it's in the same ballpark, does it? But customer, innovation, learning, financial, and internal business process, well, that sounds a lot more promising and actually like it could be put into practice in a theory. So lo and behold, even if you didn't know it, you could have still guessed it not knowing the theory on there. So just think about it logically in your exam, but also go away, have a read of the balanced scorecard and understand the different quadrants, the internal and external factors and processes that are all about improving performance on there. So the scorecard in question is balanced in that it requires a manager to do what? Deliver performance in all 4 areas. That sounds pretty reasonable to me. The second one is offset bad performance in one area with good performance in another. Well, as a manager working in an organisation, you want to be actually optimising all of the different areas, not just accepting one is bad, because then that would go against an actual balanced scorecard on there and the theories behind it. So that's definitely not it. And then finally, one that would really give you a bit of a curveball, but you've got to think about this logically from a business point of view, is to achieve an equal number of KPIs in each perspective. Well, KPIs are more associated with directors, higher up in the hierarchy, the sort of annual reports on there that we have to disclose to external stakeholders. It's not really sort of in fitting with a balanced scorecard in those different areas like we touched on with customers, innovation. So for here, as we know, with the balanced scorecard, we've got 4 areas, and you want managers to deliver performance on that. So logic would hopefully dictate that you'd pick the top one on there and get yourself another easy mark in the bank that could be the difference in helping you to pass this part of your exam. And that walks and talks you through, nice and easy, pretty quickly, but it's, I don't know how rushed you are if you've got your exam tomorrow, 30 out of 30 marks for the 3 section B questions on the full CBE, tip-top on there with all the formulas explained and calculations. If you have enjoyed today's video, be sure to give it a massive like and thumbs up below. As ever, thank you so much for all the support for the channel. I really appreciate it. As you can see, it's a nice sunny day. I'm treating myself to some management accounting. So let me know in the comments any other requests that you've got, how you get on the exam. I'd love to hear maybe where you're actually watching this video as well. And of course, be sure to subscribe so you don't miss out on any other future videos. And who knows, the next video could be dedicated to you and could be the difference in getting you that 50 plus, the 30 marks that we've looked at today, passing this exam and getting you ACCA qualified. Well, on that bombshell, we'll see you next time. Cheers.